Well, if you want to know anything about Airbnbs, short-term rentals, then I've got the guy for you today, Mr. Taylor Jones. So Taylor and I are both, he's more involved with the company TechVestor than I am, but also I'm involved as well. That's how we got connected. Short-term rentals and Airbnbs are just killing it right now. So Taylor, thanks for joining us today on the show.
Absolutely. Thanks for having me, Jeff.
So, Taylor, you're the head of acquisitions at TechVestor, which, that's how we met. So, we'll get into a little more of what's involved with that, but tell us a little bit about how you got started in real estate in the first place.
Yeah, so I'm a lifelong sales guy actually. And when COVID hit, I had a, face-to-face client-facing sales job. And when we could no longer visit clients face-to-face and secure contracts, my job was kind of on pause for 2 or 3 months. And that was kind of my like, oh crap moment that I've got all my eggs in one basket and I was really good at sales and continuing to climb and make more money, but really needed another option. And I always had an itch for real estate, just wasn't sure whether I wanted to do wholesaling, flipping, long-term rents. And as a consumer of the product, so me and my wife, we've stayed in Airbnbs like a lot of people have, dating all the way back to 2015. And after I kind of looked at all these different options for real estate investing, once I got into short-term rentals, I was like, man, there's some awesome yield opportunities here. So I did the crazy thing and I end up watching 200 hours of YouTube videos to consume as much content as possible. The good news was, I had everything on my hands of time from that standpoint because the sales job was on pause. And I read books, articles, blog posts, and really consumed a ton of data and inputs. And at some point, kind of made the decision, you know what, let's just go for it. Let's start writing some offers. 5 offers later, we finally got one accepted. So me and my wife bought a cabin up in the mountains. I'm here in Florida, so it was not even close to us. It was an 8-hour drive, but we'd been to this town and vacation there before. And the journey was off and running at that point. I kind of looked at getting into real estate and before I got started, I was like, man, I'll just keep my sales job and I'll buy one a year for the next 10 years and, it'll be great. And unfortunately, once you got in, I got hooked and addicted pretty quickly. And it's kind of like tattoos. It's a mile to the first tattoo and an inch to the second one. And so that's kind of how it was with short-term rentals. Once I got that first one, 5 months later, got the second one, and haven't looked back ever since. So it's been a crazy journey, and have learned a lot, and excited to keep pushing forward.
So somebody out there that's considering maybe they have a long-term rental now, maybe they're considering turning into a short-term rental, or they just want to get started. Just where would you tell that person, the first place to start since you've been there?
Yeah, I mean, definitely try to consume as much content from various different people. What is tough in today's age is there's some people who are putting out content exclusively to make money on the education side.
Mhm.
So it's really hard to find that, those good short-term rental people who are giving away content that's actually helpful, but not charging you for it. I was fortunate 3 years ago. That was kind of before the whole selling a bunch of courses and sign up for seminars and all of that exploded. And so now it's very saturated. It's really tough to tell who's really actually giving value and who's not. But, I would just consume as much as you can from different people, blog posts, different books, and, really learn about the different aspects. Because when you look at short-term rentals, there's different sections of the process. So step one in section one is the actual acquisition. And what you got to be familiar with is understanding how to underwrite these from
Mhm.
a revenue and expense standpoint. So, you could spend days, weeks, months just understanding, learning how to do revenue comps, how to underwrite expenses, utilities, maintenance, etc. Step two is the preparation stage. So you've closed on it, you bought it, you think you have the right numbers. Now you have to renovate it, design it, and add all the appropriate amenities. And, understanding what's the best design, what are the best amenities to drive ROI, there's an art form and a science to understanding that. So you need to study and learn, for your area and for your type of product, what are the best amenities to add to drive revenue? What's the best design, whether it's contemporary or modern or mid-century or, whatever it is. What renovations are worthwhile? Do you really need, marble countertops, or can you get away with a, clearance rack granite type of product? So understanding all of that is kind of phase two. And then phase three is the operational side. That's setting up all the tools and, actually managing it. Or, some people take the route of hiring a property manager to take that off their plate. But, either way, you need to be very intimately familiar with all three phases: the buying side up front and underwriting, the setup and preparation stage in phase two, and the operational side of phase three. So, what I tell people is understand those three phases very well. Naturally, you'll be really good at one, okay at one, and not as good at one. And, to me, that's kind of where I found what I was good at. And that was the upfront side, is the underwriting, the buying, the acquiring.
Speaking of underwriting, do you have like some target returns for people?
Yeah, I mean, it's definitely all relative to what you're looking for. I mean, just last night I had somebody hit me up and say, "Hey, me and the wife are looking to get a cabin." He lives in Miami in South Florida,
Hmm.
and he's like, "Hey, we'd love to use it 2 weeks a year and break even." So, depending on what your actual investment thesis is, you could decide, "Hey, I don't want to ever use this. I want the best yield possible." That's one end of the spectrum. And the other end of the spectrum is, "Hey, we'd love a second vacation home that doesn't cost me any money." So, you really can find anything in between, from, "Hey, I'm never going to use this and we want to maximize yield," to, "Hey, I want a really cool vacation, getaway, whether it's, escape to the beach, escape to the mountains, escape to the lake. And me and the family want to come use it, 3 days or 3 weeks a year." So it's really just depending on where you're at in life and what you're looking for,
Hmm.
which is the great optionality of this asset class versus, say, multifamily or self-storage, where you're never going to go stay in that apartment or rent, put up a campsite inside the steel box door of your storage facility. So that's kind of the great optionality that short-term rentals provides people.
So why would somebody invest like with a group, like with you, with TechVestor versus just doing it themselves? What maybe the pros and cons?
Yeah, I mean, pros and cons are going to be a couple different facets. So, let's go from the owning it yourself side. When you're owning it yourself and you're sitting back and cherry picking, that perfect property, you can absolutely go find yourself a home run and generate a high total return. But you're going to have to nail the underwriting. You're going to have to make sure you buy it at the right price. Most likely there's going to be a level of renovation to it. There is no high yield turnkey properties anymore, since everybody's buying. So a
Hmm.
lot of your value comes in finding that deep value add. And you're going to need to be an elite operator or find an elite operator via property manager. So, on the buy side, I always tell people is you get all the upside of hitting a home run, but you also get all the downside that you could strike out. So, part of my baseball reference, I'm a washed up baseball guy myself, but, that's kind of how the buy side works. Investing in a diversified portfolio, kind of like what we do, is, yeah, you're getting a blend. So you're not getting that home run, but you're also not getting the strikeouts. You're getting a lot of singles, doubles, and triples mixed together. And so
Hmm.
what you get is diversification, and you also get done for you and passive. So depending on that phase of life, if you want to go tackle the renovation and study the underwriting to maximize the yield, and you have the time available, then yeah, go buy yourself one for sure. But if you're a busy professional and you're like, "Hey, I have extra capital that I want to put to work. I'd love some, passive income from it, and I don't want to have all my eggs in one basket," then investing in a diversified portfolio is an option for you. And, like I said, because you have that risk spread out throughout tons of different properties throughout the US, you're also, you're also de-risking it up against one individual asset. So what I mean by that is, I'm here in Florida. If you have one beach cottage and a hurricane comes in and wipes you out and you're offline for 6 months because your home flooded, which we just had two really bad hurricanes this past year in Florida, I know several investors whose properties got flooded by the hurricane and their property was offline for anywhere from 2 to 6 months, getting rebuilt, new drywall, get rid of the flooding, dealing with insurance. So those are all risks you take on with one individual asset versus having a diversified portfolio where, not one singular asset could wipe you out.
Kind of like difference between investing in a single stock and a mutual fund, something like that. You're spread out. So
Absolutely.
with the fund, so I was telling you before we started the call, I had a dentist actually this morning reach out to me. Been practicing for several years in Miami. Uh, was taking extra money. Was really wanting to get in multifamily. Really wanted to buy like a 15 to 20 unit apartment complex, but right now I think he has two or three homes he's doing short-term rentals, Airbnb with, and he's just kind of worn thin, with practicing dentistry and spending. He wrote down how many hours. It was like over 100 hours a year that he's spending, dealing with tenants and that sort of thing. So regarding the fund, I know both you and I are involved in the fund. Tell us a little bit about how that works. Like, what's the minimum? What sort of yields can they expect? What's expected of the person that invests in it? Like, what's their time commitment? Maybe give me kind of like the high level view of that.
Yeah, certainly. So, for us, we're, balancing risk and upside on every acquisition. And, when it comes to delivering those returns, we're always looking for double digit returns. So any short-term rental we go in to buy, we're always looking for double digit yield. And, on top of that, what you're getting is all the great tax benefits that come with owning real estate. So when you really start compounding all those things together and start looking at your total return plus your yield plus your tax benefits, it can really go a long way in, maximizing your return on your investment. From a time standpoint, it's few and far between because our team is operating everything. You're getting those passive quarterly dividend payments. There's weekly and monthly emails. There's quarterly newsletters that go out. So what's really great is you're getting to kind of see and watch that investment as in depth or as not in depth as you want. If you want to track the bookings, we have that available, every week, so you could see all, how the fund's performing and everything. If you just want to watch the quarterly Zoom and newsletter that goes out and kind of get hey, give me the Spark Notes of the last 3 months, that's available as well. So I think for people who are busy, have capital they want to put to work, and get exposure to this awesome asset class, getting involved in a fund like ours is the best approach to do, because you're getting all those things done for you, where you're not having that overcommitment, you're not stretched thin, you're not exposed to just one market. You have the diversification across several markets, several different types of products, whether it be cabins, beach cottages, lake houses. You're not overexposed by a weather, by regulation. Having all those put together is how we strategically built this portfolio to continue to offer the best risk-adjusted return for investors.
So let's say somebody invested 100 grand in it. What does that look like over whatever time period, like a whole period?
Yeah, I mean, we're a target 5-year hold. So, the whole idea is, we're going to use that capital, we're going to buy properties, we're going to renovate them, design them, and
Mhm.
operate them very well for the next 5 years. So there's quarterly dividend payments over the next 5 years. And then ultimately, we're going to bundle up all of these turnkey cash flowing short-term rentals together, and we're going to sell them to some large institution who wants everything done for them. A lot of these large institutions don't want to go buy a 500K home, renovate it, design it, furnish it, operate it. They want it all done for them. Here's the keys. It's all set and ready to go. And so for us, we're building, that void that's in the marketplace, because if you want to get some turnkey self-storage facilities that are up and operating, you can go do that. If you want some turnkey multifamily apartments, you can go buy those. What you can't go buy is 50 or 100 turnkey cash flowing short-term rentals. That doesn't exist in the marketplace. So if you're a big institution who can write a 25, 50, $75 million check, and you want short-term rentals and you want yield, where are you going to go? And so for us, that's why we're building this fund and this opportunity, is so that we can have that. So when we do go and ultimately exit, sometime over the next 4, 5, 6 years, What you're looking at from an investment standpoint, our goal is to 2x that money. So meaning on 100 grand, you'd be getting 200 grand total. So that's your return of capital plus profits. That's ultimately the target that we're setting for our exit multiple. Hey, nobody's done this before, so could it be higher? Yeah, absolutely it could. But for us, we try to be very conservative and looking at, the marketplace and where we're at and what we're doing. And so that's our target goal, is hit that number for our investors, and that'll make everybody happy, including ourselves.
Well, your company is, a technology company first, or, you use a lot of technology. So how are y'all using technology to deal or manage with the homes as it is now?
Yes, certainly. We built our own internal software where we can track all these listings across the US. So we're currently tracking over 290 markets across the US. So we can see in our software every listing that hits the market. And then we're going to cross compare it with, short-term rental data that we pull in from one of our key data partners. And so
Mhm.
we've mirrored the two softwares together. And so in real time, we can underwrite and source over 100,000 short-term rentals a month to see what the best yield options are. Now, we are not going to do iBuying like Zillow or Opendoor, because we've seen how that's gotten them in trouble. But for me and the acquisitions team, what the software does is it helps us eliminate the deals that don't make sense. So right off the bat, we eliminate anything that the software doesn't predict could be at least a double-digit return, which is 96% of all listings across the US. So what we do and are left with is that 4% of listings that the software says, hey, I think these could be good double-digit cash flowing short-term rentals. That's where me and the team are going to add that human element and really look, because, AI software tech can't identify the bones. It can't identify, hey, is there a hoarder or a trailer park or a cemetery next door? Those things would obviously affect your revenue. So, having that human element to make sure, because these are all different single family homes, they're not 10 by 10 steel boxes like self-storage where they're all the same.
Mhm.
So you always need that human element for that last, 20% of the process. But for us, we're not wasting man hours on underwriting or looking at deals that we know will never work. So that's the great advantage the software does. It gives us the data to really focus on the deals that could work so that we can scale quicker, more efficiently, and more profitably.
Yeah, that's amazing that y'all can underwrite just comparing to somebody that wants to do it themselves, just going, okay, well, I'm gonna go in the Dallas or Fort Worth area. Let me start looking on MLS, and just thinking about that compared to that. There's really no compare. What comes into my mind is, like, if you're wanting to go to like a sporting event or something, it says, hey, next Wednesday, 9 a.m., tickets go on sale. You log in at 9:01 and 80% of the stadium's bought up. It's kind of like that. It's like, you're competing against, technology. And then now, you're having to go through that company to buy the ticket. So that's what I kind of think about with, there's no way you can compete, is that right?
Yeah, it's a huge advantage versus a one-off investor who's
Yeah.
looking, scrolling through Zillow one at a time and trying to figure this out. And for us, we also get to see all these revenue comps. So we get to see what the top performing Airbnbs are in any given market, whether it's Dallas, New York, Florida, Georgia, Texas, Colorado. Then exactly what to look for. So now you've got that honed in eye, because you could say, hey, all the top performers, they look like this, or they have these amenities. Or you can even see geographically. So even if you've identified, okay, Dallas is a great market, for example, well, is it better to be on the east side, the south side, the north side, or the west side? Where's most of the revenue coming from? So you think having access to those data gives us a key advantage, because you might just think, oh, well, Dallas is a great STR market. But then we're going to narrow it down to the exact zip code, the exact neighborhood for where the best revenue is. So, yeah, you might be like, cool, I'm making a pretty decent return because I found this good market. We're going, how can we get the best return, because we're buying in the best zip code in the best neighborhood to drive the most revenue in this area. Those are just key advantages that having data access like we do gives us super strategic advantages over the common investor.
So speaking of markets, what are some of the markets that you guys are currently in now? And what are some of the ones that you're maybe looking to get into potentially?
Yeah, I mean, today we're currently in Arizona, Missouri, Illinois, Florida, Georgia, Tennessee, Virginia, Pennsylvania, and New York. So as we continue to expand, we'll continue to buy in some of those markets that we've already vetted, found that the
Mhm.
data is good. So as we continue to see opportunities to buy, we will. As far as expansion, we're looking at places like Texas, Colorado, and a couple other scattered markets throughout the US. But those are kind of where we're at now and what's kind of on the horizon, possibly adding in places like North Carolina, South Carolina as well. So those are kind of where we're going and where we're at today.
What are some of the things that the pandemic taught you about real estate?
I think the pandemic taught a lot of people, about risk and
Mhm.
understanding, do you have all your eggs in this basket? And what I mean by that is a lot of people who had places in, say, Hawaii, when they shut down travel to Hawaii, you were kind of, SOL per se. I think people with downtown metropolitan Airbnbs got wrecked. There was no more traveling to the city. If anything, people were fleeing. We were fortunate that we owned some cabins in places that were an hour to 2 hour drive away from the metro. And our growth absolutely exploded. And that's because people were escaping the city. Now, metropolitans have made a comeback. So it's like anything, it's a pendulum. Whereas everybody was escaping the city, now they're coming back to the city.
Mhm.
And so I think having diversification is super critical within a portfolio because, again, you're not overexposed to one event. I look at it the same as people who invest and buy Airbnbs by Disney. Yes, you get 80 million statistical visitors a year, but what happened when Disney closed for 3 months or 4 months or whatever it was? There is no draw outside of the theme park there. So I know a lot of people who sold. I think the stats were at the peak pre-COVID. There was somewhere near 50,000 Airbnb listings in and around Disney. And that number dropped all the way down to about 32,000. So you're talking 18,000 listings either being pulled offline, sold, or converted into a potentially a long-term rental or whatever it might have been. So if you're all in on one spot, it comes with a lot of upside and it comes with a lot of downside. And that's really kind of the common theme that I've seen in events like COVID, natural disasters, weather, regulation changes or shifts, traveling patterns or shifts. Those are also big things that affect your revenue and your profitability of your short-term rental.
I know that you're currently living in Orlando, but you guys don't have any listings there, right?
No, no, we do not. I'm not a big fan of that market personally for a variety of reasons. Saturation being one of them.
Mhm.
Institution capital being here. There's a lot of nuances to the Disney market, and for us, it just does not make sense with our investment thesis to try to enter that market. So, unless drastic changes in the marketplace shift, we don't see us from the fund standpoint entering the Disney market.
So if you had to invest in a market in the US like this month, like, hey, you have to, here, we're going to give you the keys somewhere. Where would you go and why?
Well, I mean, I'll tell you where my own personal capital is. Me and the wife, like I said, we own a couple STRs. I've been very bullish on the Southeast Mountains as a whole.
Mhm.
Um, for a variety of factors. The East Coast of the United States has a massive population. Compared to say the West Coast. Something like 50% of the population is east of this line or whatever it might be.
Yeah.
Other thing is drawing in people like me who are born and raised in Florida is it's the easy escape. I love Colorado. I have family from Colorado and we love going out there, Utah, going out west, but it's hard. And sometimes plane flights can run, three, four, five, $600. Whereas you could catch an easy flight for, 150, $200 to Atlanta and boom, get up to the mountains, or you can go into Charlotte and then boom, get over to the mountains of North Carolina. So, personally, I've got some cabins in that North Carolina, Georgia, Tennessee range. And as a traveler of those destinations growing up as a kid, and seeing that there's always really built-in demand because you have drivable opportunities from the metros, as well as everybody and their mother leaving Florida in the heat when it's 105 degrees to escape. I just don't ever see a drop in demand. So to me personally, super bullish on the Southeast mountains. The fund we own in those markets, and I personally have my own capital in those markets. So, that's where I'm at today, and I'll probably continue to invest there as long as, there's opportunities.
So when somebody's looking at, short-term rental, a home to do a short-term rental, is there like a target price? Should they look at like really nice luxury ones, or should they look at some that are just a typical 3-2 house? I mean, what are your thoughts about that?
Yeah, I mean, I'd say there's a couple different, segments you can fall into. So, you can go after luxury, and luxury has its pros and cons. And that takes a specific type of investment. You also have to set it up a strategic way. There's renovations you have to do to compete in luxury versus the others.
Mhm.
Um, there's also, on the low end, there's the affordable STR. So it's kind of like a race to the bottom on price or giving the best value, where you might have a 1-1 condo or a 1-1 studio. And you're just appealing to couples, solo travelers, business travelers, and you want to offer a better alternative to hotels, but you're on the lower end. And then there's everything in the middle, whether you're, operating a 2, 3, 4 bedroom and you want to appeal to families, small groups. And so really it's just depending on your market and, what you're offering, because you can win on a variety of factors. You can win on location.
Mhm.
You can win on amenities. So maybe you're further away from town, but you have, a sweet game room, arcades, fire pit, hot tub, etc. And people don't mind being 15 minutes away from the city center because their kids are going to be occupied, have a lot to do. So that's kind of the great thing, is you can carve out a little segment within this huge range of short-term rentals, and you have a ton of opportunity available to you.
To shift gears a little bit, what are your thoughts about people like they'll go to somebody that has a house that they're renting, long-term rent, and they'll rent it, and then they'll turn around and then they'll Airbnb it. I know a
Yeah.
lot of the college kids are kind of that's kind of one of the things that people are promoting to, like younger people. Hey, rent something for $1,000 a month, turn around and make, 2, 3 grand a month potentially. So what are your thoughts about that?
Yeah, the old Airbnb arbitrage. Personally, not a huge fan. I kind of equate it to like wholesaling on the real estate side. It's a way to enter the space for cheap, meaning, you're really just putting up first and last month's rent, on a typical lease,
Mhm.
and then paying for furniture. So compared to, down payment and reno and buying an actual asset, yeah, I mean, it's a lot tougher. Um, there's a lot of cons to it, and that's risk number one. At any point you could get shut down. Typically too, the doing it with apartments, and in the metro cities, there's far more regulation than say the suburbs or vacation markets. So right off the bat, it just carries more regulation risk. Number two, at some point, if you're having great success, the landlord might not renew your lease. And he's like, I'm just gonna do this myself.
Yeah.
Or he might just kick you out because he's like, hey, I'm sick and tired of this. Number two, you don't get any principal pay down, so you don't own any assets. You're glorified renting. You also don't get any tax benefits. All of that money you make is income tax. And if
Mhm.
you're a higher net worth individual or you scale up your rental arbitrage, you are getting fully exposed to those 20, 30, 40, 50% tax brackets. And so a 10% return in rental arbitrage might be the same as a 7% return in actual owning of real estate, because you don't have those benefits. You don't have principal pay down. You don't have all those things. So I, I do, appreciate the grind and the hustle, especially if you don't have a lot of money to your name or don't a lot of money to get started. But what I always tell all of those people, and just hope for their own sake, is they stack cash and eventually go buy hard assets. I see a lot of people who just said, no, I'm going to double down and reinvest and secure more leases. And it's a house of cards that could come tumbling down. I've seen people have hundreds of leases in a given area get shut down overnight with the snap of a fingers. Won't say any names, but you can do some searching where there was, some big top dogs in the space who had 100 leases that overnight got canceled by the city. And, if you don't have a plan B, and all your chips are in that basket, you can be in some big trouble. So I just hope and pray that all those people stack their cash and use it to buy hard assets and get out of that space for the long term.
Yeah, speaking of hard assets, I spoke recently to a local medical school here, and just about basics. Wish somebody would have done that to me when I was in school, even in college, even in high school. But was just talking about, hey, how when we get out, we delay this gratification for so long, and we get out, it's like we got this pent up demand. We want to immediately catch up with our friends who've been working for 8 or 10 years with, buying a house, cars, vacations, all this. And then when we're so far in debt too, and then we're just focused on, okay, well, if I'm maxing out my 401k every year, then I'm good. I'm just gonna spend the rest. And I'm like, well, if I'm just telling them, say, look, if you do this, then you're set for 30 or 40 years. You have to work, because that's it. But I said, look, guys, you're going to make enough money, make two, three, $400,000 a year or more. Take a little bit of that money every year and start putting it away to buy hard assets, to buy just businesses, assets, whatever, things that are going to just start to trickle in and replace your income. And, they had never heard of that before. They thought the best thing in the world was their house was their best asset. I'm like, well, it's not an asset. And they couldn't get that out of their head. I say, are you making money with it? No, but what if it's paid off? I said, is it putting money in your pocket or not? They said, no, it's not. I said, what's a liability? Unless you're Airbnb in it.
Yeah,
So
absolutely.
it's amazing how, and I'm looking back, I was brainwashed as well, just how you're stuck. You get in the rat race like this. So I'm just constantly, my kids are uh, teenagers, and I'm constantly just trying to get them involved in this. It doesn't matter what you do, go do whatever you want to do, whatever your interests are or whatever, that's fine. But consider, as you're doing this, making money, replacing your income. So you work because you want to, not because you have to.
Absolutely.
So, and I kind of look back and see how I would do things differently. So for you, knowing what you know about real estate in this process, what would you do differently?
Man, I've been asked this before, and the biggest change I would have made was probably house hacking my very first house. And what I mean by that is buying a duplex, triplex, or quad. So a sub 4 unit, just because you should still get that, first time home buyer loan opportunities. Rent out the other units and, in essence, have my mortgage either covered completely or covered part way. Being married now, it's a non-starter, unfortunately. But back then, when I was just dating my wife, and there was that opportunity, before getting really settled down with kids, I think it's a huge jumpstart. And depending on where you're at, you could do it as a long-term rental. If you bought a duplex, lived in one half, rented the other, or if you get in a great area, in a great spot, you could short-term rental and even juice your returns. Then when you are ready to move out and scale, you have that locked in at, competitive terms, low down payment, low out-of-pocket cost home. And now you're renting out both sides, assuming it's a duplex.
Hmm.
And you got two long-term rentals now, or you have two short-term rentals. And now you can pivot out. And I think it just is an accelerant on your real estate wealth building process that I wish somebody had taught me. I didn't understand the value of that. The other thing is potentially buying a rental property. So if you don't want to go down the house hacking route, is buying a rental property before your primary residence.
Yeah.
And I know that seems, ass backwards to people, but I've seen a lot of strategic people who rented for 5, 10 years. And actually, instead of saving up all their excess cash and putting it as down payment to buy a home to live in, they just rented in a modest place, weren't getting no penthouse suite on the beach. And they saved up, bought that first rental property, and boom, now they're making an extra $1,000 a month. And they're like, okay, I'm going to take my excess income plus my $12,000 a year in free cash flow I'm making from my rental. And you can either use that to go buy a secondary one or use that to get into your primary residence, and then boom, save up and go get that second rental. And I think all of those things do, when you have income paying you from your money, it just accelerates the growth that you're able to do versus getting behind the 8 ball and buying a house that's not giving you any income. And you're just further behind the path, and it takes longer to catch up. And compounding is a real winner in the long run. So if you're able to get that house hack or that rental early, that would be the absolute biggest change I would make. Yes, I'm early 30s now, which is young comparatively, but I think I could have done some serious damage in my early 20s had it been explained to me properly with all the knowledge I now have learned in my early 30s.
Awesome. Well, I really appreciate your time today. So how do people find Taylor Jones?
Yeah, I hang out on Twitter primarily. Try to post a lot of tips, tricks, and share. I'm a rising tide lifts all boats kind of guy. So some people are like, man, you give away a lot of insight into short-term rentals. Aren't you scared? I'm like, honestly, I hope everybody does a great job in this asset class. So, find me on Twitter at Mr. Jones STRs. And then recently started posting more on LinkedIn as well, just at Taylor Jones. My giant jugular face is on there, looks the same as it does on the podcast. So, that's where you can find me, is on Twitter and on LinkedIn.
Awesome. Awesome. Yeah, I follow you on Twitter. Highly recommend it. I've learned a lot. So love your threads for sure.
Thank you, Jeff, man. Yeah, trying to give back as much as possible.
Take care.
You too.